Lockdowns definitely do not work. Lockdowns kill more people than they save. Query if they save any. So an extreme form of lockdown, but in the United States, it would take martial law. But more to the point, what are you going to do? Stay locked down for the next 20 years? You're gonna undo your lockdown at some point. You know what's going to happen? The best the lockdown can do, it's a time shifting thing. It does not reduce the total cases. It does not reduce the total fatalities. It can temporarily reduce the spread at enormous cost. But the minute you try to reopen, the spread comes back again. That's exactly what happened in the United States. And by the way, we have data. Here's the thing, Kerry. We have data from 35 or more countries around the world that all did it differently. Sweden, Japan, Australia, the United States. And in the United States, because of our federal system, we have 50 different states. We had extreme lockdowns in New York. The governor of South Dakota had no lockdown. She just said, you know, come see it. Come. Okay. So we have, the point is, across the spectrum of lockdowns, from no lockdowns to extreme lockdowns and everything in between, the experience is identical. The caseload and the fatalities are the same, which means that lockdowns don't work. You can try them, you can do them, you can destroy your economy, but you're not going to change. A virus doesn't care about your politics. A virus doesn't care about your economics. A virus just wants to kill you. That's all they know. And so lockdowns destroy the economy for no gain. Okay, you want to debate the gain, that's fine, but they do destroy economies. I don't think there's any debate about that. Washing your hands, social distancing, let's throw in masks. You get 90% of the benefit at 10% of the cost. It's that last 10% where you destroy your economy to save a few K. By the way, you know what lockdowns do? Suicides, drug abuse, alcohol abuse, 100%. Domestic abuse, anxiety, depression, people not getting treated for other things. More people are dying because of lockdown than are being saved. Okay, done. Now, but lockdowns cause recessions. That's easy. That linkage is 1-to-1. So because of the new lockdown in the United States, the US will go into a recession in the first quarter. It'll be back-to-back recession. We did have that in 1980, 1981. We had 2 back-to-back recessions separated by a year. This will be separated by about 6 months. So deflation is the problem. So what can investors do? I said earlier that monetary policy doesn't work because of velocity, and that fiscal policy doesn't work because the debt to GDP ratio is too high. And I said there was one thing that does work, but I didn't tell you what it was, but I will now for you and the audience. Deflation is the problem. We have disinflation now. We're going into deflation. Deflation is the problem. You have to break the back of deflation. You have to cause inflation. I know inflation is a naughty word among gold investors, but actually that's the best way to get the price of gold to go up a lot. It's going up anyway. How do you get inflation, especially when you need it, when you're suffering from deflation, which is bad in its own way? You have to change the psychology. And it's been done twice. It was done in 1933 by President Roosevelt, and it was done in 1971 by President Nixon. And both times they devalued the dollar against gold, which means you increase the dollar price of gold. Everyone says, oh, gold's going up, gold's going up. And I say, no, yeah, it is in dollar terms, that it is. But what you're missing is that the dollar is going down. People come to me and say, Jim, you've been predicting for years the dollar is going to collapse. When's it going to happen? I said, it already did happen. What do you think happened between December 16, 2015 and August 2020, when the price of gold doubled from $1,000 an ounce to $2,000 an ounce? In round numbers, it was 1051 to 2019, right? But call it 1,000 to 2,000. When the price of gold doubles, the value of the dollar is cut in half, measured in gold. The dollar already collapsed, but everyone's looking in the wrong place. They're looking at the euro, the Aussie dollar, the Canadian dollar, the Japanese yen, the Swiss franc, whatever. These are all passengers in a lifeboat, okay? But they don't, you're all in the same lifeboat. Some are taller, some are shorter, some are smarter, some not so much, but they're all going to sink or swim together. And that's what currencies do. There's one and only one form of money which is not in the lifeboat, which is an objective measure, a yardstick independent of central bank policy, and that's gold. And you've got to devalue the dollar against gold, which means increasing the dollar price of gold, to break the psychology. And the reason you're doing this, of course, gold investors would love it, but that's not why a central bank would do it. They would do it to change the psychology and increase the price of everything else. Franklin Roosevelt did it in 1933. He increased the price of gold from $20 an ounce to $35 an ounce. And he didn't do it to reward gold holders. In fact, he confiscated all the gold first. So it was the ultimate insider trade. But what happened when the price of gold went up, guess what else happened? Oil, wheat, corn, steel, land, everything else went up, and people could pay their debts and the economy got going. And we had a boom in the middle of the Great Depression. We screwed it up again in 1937, thanks to the Federal Reserve. Nixon ended it once and for all. FDR did it on purpose. Nixon did it by accident, but the result was the same. From 1977 to 1981, we had 50% inflation, 50. The value of the dollar was cut in half. Gold went from $35 an ounce to $800 an ounce, which was a 2,700% gain measured in dollars. And by the way, the price of everything else went up, again, oil, real estate, etc. So the only way to break inflation and get inflation is to increase the dollar price of gold. And there's no reason the Federal Reserve can't do it. They're not going to, by the way. We're going to have years. I'm giving you the solution. I say the same thing to people in Washington. They don't listen, but I'm happy to share. I'm giving you the answer, which is you've got to increase the dollar price of gold to get the inflation and everything else to get out of the deflationary rut. You have to do it. And by the way, it solves the debt problem because the debt is nominal. I'm a big fan of real numbers, but debt is a nominal thing. If I owe you $1, I owe you $1. It's interesting whether it's actually worth 95 cents or $1.10 because of deflation or inflation, but I owe you $1. That's the contract. Well, if you have inflation, guess what happens to the real value of the debt? It goes down. If you have deflation, what happens to the real value of the debt? It goes up. You go broke. So you need the inflation to solve the debt problem, break the back of deflation, get the nominal economy moving, solve all these problems at once. But they don't understand it. The Fed forgot how. For example, the Federal Reserve, the board could go in the room, close the door, take a vote, walk outside. Jay Powell could walk up to the microphone and say, ladies and gentlemen, as of now, the price of gold is $5,000 an ounce. And if you think that's cheap, come and get it. Fort Knox, the door's open. You can buy all the gold you want. And if you think it's rich, we'll buy it from you because we got the printing press. So you use the gold in Fort Knox and the printing press, and your buyer at $49.95 and your seller at $50.50. If you do that, the price of gold is $5,000 an ounce. It's an open market operation. How do you think they control interest rates? They buy and sell bonds. If you want to control the price of gold, buy and sell gold. And by the way, don't worry about the amount of gold in Fort Knox because there's 10 times as much on the open market in private hands. It may not be, everyone's like, the gold mining output only increases 1.6% a year. Well, that's true. But it's irrelevant because there's 150,000 tons of private gold. You can print money and buy that gold all day. And it's just another open market operation. So it can be done. It has been done, but it won't be done soon. So what better opportunity is there for investors to buy gold today? You're front running the central banks. They're going to get there. It's just going to take them a while. But you can front run the central banks and make huge profits. So if gold goes from $2,000 an ounce to $3,000 an ounce, that's a 50% gain. But if gold is $14,000 an ounce and it goes to $15,000 an ounce, that's a 7.1% gain. It's still $1,000, right? It's real money. It's $1,000 to you, the owner or the holder. But as you get to higher levels, the percentage increase drops because you're working off a larger denominator. So everyone's like, $15,000. What they don't understand is the last $5,000 will happen in the blink of an eye, because it's to go from 14 to 15, that's a 7% gain. That's 1 week's worth of volatility. You're going to start to see $100 days routinely. You almost do today. You're going to start to see $1,000 a month routinely, because at each level, the same $1,000, you still get the money, but the $1,000 is a smaller percentage of the then existing base. So you're going to go from 10 to 11 to 12 to 13 to 14, just like that, maybe a year or less. Now those are bigger gains today. $1,000 today is a 50% increase. But then when you get to 3,000, another $1,000 gain is only a 33% increase.
Exactly.
At that point, it's only a 25, et cetera, until it becomes trivial, or at least small relative to daily volatility. So So get your goal now before that happens, because if you're waiting for I'm going to wait till it gets to $8,000 or $9,000, you're going to miss out. First of all, you will have missed out on the early gains, but you're in danger of missing out on the late gains, because it's sort of like the hockey stick, that a lot of the gains in these bull markets happen at the end. All the more reason to get in at the early stage, because you need less money to do it. If you get the laws of economics right, which is not easy because most economists don't, but if you get them right, it's really a reflection of human nature. I mean, what is an economy other than all the people in the economy starting businesses, buying, selling, traveling, providing goods and services, etc. So human nature doesn't change, or at least it hasn't changed much in the last 100,000 years. So the fundamental laws of economics don't change either, but circumstances change, facts change, and that's important.